All right, well, we will make a start and just do some introductions first. So thanks very much for attending this financial reporting update. Most of the content is equally as relevant to for-profits and not-for-profits. It's just about timing. And so whether you're a for-profit or representing a not-for-profit in the room today, a fair chunk of this content will be relevant to you. I will try and distinguish between the two as I go along to help you out there. But yeah, if it sounds like I'm talking about not-for-profits, there's probably a for-profit context as well as I go through. So my name's Jeff. I'm one of the audit partners here. Look after or oversee some of our technical financial reporting. With me today is Edward Jones. So he's senior manager in our group. He also has real technical expertise, but what he's going to be doing is similar to what we've done previously if you've attended. If you put questions as we go along into the Q&A, Edward will answer those questions as we go, and so he will type answers. But at the end, when as we wrap up, if there's some similar themes or questions that have come through multiple times, we'll get Edward to ask me those questions, or he'll just jump on and provide answers to some of those questions to the broader group as well. So that's how we're going to run that. So it's in the Q&A box, not the chat box. So yeah, if you utilise that, please go ahead. I'll preempt the first one. Yes, the slides are made available, and yes, there will be a recording up on our website. So that's just saved those ones. So I will jump into it and work my way through. We have a scheduled finish time in the meeting invite by 1:15. That'll be at the latest. I expect to be able to wrap up by around about 1 o'clock, and then depending on how many questions there are post that, we can keep going. But it's probably a little bit of a shorter presentation than I've had sometimes in the past. All right. So today I'm going to work my way through some broad topics. First of all, I'm just going to recap who needs to report. So who has to lodge financial reports and to whom. I'm then going to jump into special purpose reporting and what's been going on in special purpose reporting and some proposals around new tiers for not-for-profits and a new tier of accounting standards in effect. I'll then talk my way through the changes in reporting that impact you this year. So I'm just doing special purpose first because that will put into context the changes in reporting. And then I've got some emerging NFP issues at the end, just a few slides. So hopefully I'll have time to get through those and just inform you on a few things that we're seeing in the marketplace and in the sector, not-for-profit sector particularly, and just give you some heads up around some of those. So that's broadly the agenda. So first of all, who needs to report? So start with large proprietary limited. So this is for-profit entities reporting under ASIC or under the Corporations Act. There's been no change to the threshold. So on 1 July 2019, the thresholds increased significantly and in effect doubled. And so now you are only required, or you're required to report as a large proprietary limited for-profit company if you have 2 of 3 of either greater than 50 million in consolidated revenue, greater than 25 million in gross assets, so gross assets, not net assets, and you have more than 100 employees. I would note that all these tests are based on consolidated calculations. So you do need to understand if you have other entities that would be consolidated under the accounting standards or not, as to whether you're within those thresholds. And large companies, so anyone who meets those criteria or 2 of those criteria, you are considered a large organisation under the Corporations Act, and therefore you must prepare and lodge with ASIC general purpose audited financial reports. So that is your requirement. And I'll go through about what that means for you around what you need to report in a little while. If I jump over to ACNC registered charities. So as a response to the legislative review, which happened about 6 years ago now, just note where basic religious charities maintain their requirement that there is no you have no requirement to report in relation to financial reports. You still need to do an AIS. And so that requirement has not changed and is not on the agenda at the moment. Whether with the new government it becomes part of the agenda, I don't know, but there's no agenda to change the BRC classification or not. Outside of that, the thresholds have changed from 1 July 2022, but really that means years ending 30 June 2022. The 1 July is about when you have to, from a date from when you have to lodge, not the year end date, which is a little bit confusing. But there's new thresholds, and these have been increased from the existing thresholds which we've had since the start of the ACNC. So now small is where you have less than $500,000 in revenue. If you're small, you don't have a financial reporting obligation with the ACNC. Medium charities are now 500,000 in revenue to less than 3 million and larger over 3 million. So medium charities have to lodge financial reports and they have to be audited or reviewed. Large charities have to lodge financial reports and must be audited. For those of you that operate through an incorporated association type structure, but you're a registered charity with the ACNC, you don't, we understand that there's consultation between the ACNC and the various states where you had only report to the ACNC relief or arrangements between the state and the ACNC. That will continue despite the fact that these thresholds are now larger and different to all the states around Australia. I would note this is only for ACNC registered charities, not for other types of not-for-profit entities, which I'll talk about in a second. So those are the not-for-profit types of entities. We're talking about companies limited by guarantee that are not charities. So for you, you remain under the Corps Act. So these are the old, what were in effect the previous ACNC thresholds. You continue to operate under those. And as far as I'm aware, there is no intention or exposure drafts in the works to change the Corporations Act, and which would require to go through Parliament and an act to be written by, or those amendments to be written by Treasury. And therefore, given we're in mid-June, I strongly doubt that there's any change in the Corporations Act. So if you're that type of company, think sporting club, those sort of organisations that aren't ACNC charities, but they are not-for-profits, that you are reporting under the previous lower thresholds of the ACNC and the Corps Act. So no change there. If you're an incorporated association that's not a charity, so think some of the member-based bodies, peak bodies and those sort of organisations, not-for-profits, but not charities, you remain under your relevant state legislation. So for Victoria, that's the same as the table for the Corporations Act. New South Wales, for example, is lower thresholds. So you're in at about 250 into audit and those sort of things. So that's where the landscape of who is required to report sits for the current period. I'm going to jump on and talk about special purpose reporting. If you've come to these sessions before or floated around a little bit around financial reporting, you would have heard me or others talk about special purpose reporting. Special purpose reporting exists in Australia. It is not a common concept across the world, and it allows certain types of organisations to determine if they have users reliant on general purpose financial reports. If they determine they don't, then they're able to, in effect, develop their own accounting policies and move away from certain accounting standards, both in how you recognise and measure transactions and balances, but more often around how much disclosure within a financial report. That type of arrangement leads to lack of consistency in financial reporting, perhaps lack of transparency, lower level of disclosure, an argument, and potentially, or an argument could be made that that is lower quality financial reporting. As a result of that, the AASB have really been working on a project to remove special purpose reporting from the Australian reporting landscape. This has been a long ongoing project. It's been going for about 6 years. We are now, however, at the point where special purpose reporting has been removed under the accounting standard that's listed on this slide for for-profit entities this year. So if you are a large, so talk about what was large for-profit before. If you are a large for-profit, you can no longer prepare special purpose financial reports as at 30 June this year. So that will impact large proprietary limiteds. If you're a foreign-owned for-profit, unlisted publics that lodge with ASIC, special purpose, or you report under the Corps Act in effect, special purpose is now gone for you. I'd also note that if you're an AFSL entity, ASIC's confirmed that all AFSL holders need to lodge GP or general purpose financial reports again for that same period. So it applies to AFSL holders, even though you may not meet the large criteria that I talked about before. So what does that mean for you? So the impacts of general purpose financial reporting being now mandatory means you're into first time adoption if you've prepared a special purpose in the past. That means you need to prepare your reports and manage that transition either through Accounting Standard AASB 1, which provides transitional relief to certain types of transactions and balances, or AASB 108, which really requires you to go back and restate your comparative as though you had applied the general purpose accounting policies for your prior year period. And so you might see amendments to your 2021 comparative information. Where does this hit the most? So if you haven't followed recognition and measurement, when I say recognition and measurement, I just mean, are you following the accounting standard rules when you're recording your transactions and balances, or have you done something different to what the accounting standards say? So you must now follow the accounting standards in relation to recognition and measurement. The largest places that impacts around revenue and the revenue standard. It can be quite complex around timing of revenue and how much revenue you recognise when. Leases, so most of you will know that the lease accounting standard changed a couple of years ago, and in effect what was previously operating leases, think rental of your building, that sort of thing, were brought onto the balance sheet as a right of use asset, and in effect like a liability, similar to what you had with your finance leases previously. For profit, you'll have tax effect accounting apply, so you will need to record deferred tax assets and liabilities where applicable, and you'll need to do impairment calculations properly for any intangibles like goodwill or anything like that. They're probably the major areas where we see for-profits not necessarily complying with the accounting standards in the past. So they're the main ones. I'll talk about disclosures in a minute. The other one, and perhaps the most significant one, you think about all those ones, it's probably just working our way through standards with you or with your auditor or some type of other advisor. You might have the skills in-house, working your way through those standards and getting your accounting policies and accounting treatment up to date. The other major impact, and what is potentially the largest impact, is once you're preparing general purpose financial reports, you must consolidate. They have to be consolidated reports where you control any other entity. So the control-based test in AASB 10, I just want to remind you that that is do you have the power to control an entity? So that, and do you have the ability to obtain financial returns? And so it's a power returns test. I would note that that's not always as clear as, do I have 50% shareholding or not? There's a number of other criteria that need to be thought about. So that includes things like considering if you have an entity you're associated with or have transactions with, similar management or ultimate ownership, perhaps, you need to consider how did that other entity, what was its purpose and how was it designed? do you have rights as the investee that do give rise to you to power to perhaps control the board or remove key management personnel, those sort of things? If you have those rights to, even if you're not exercising that, that could be, you could pass the threshold of control. Or are there some sort of contractual arrangements that in effect give you operational control? So things like service trusts, other associated entities, those sort of things have the potential to be controlled entities. And so it's really important that you understand your group structure and the nature of your relationships with associated entities, and that needs to be considered and documented. You might already be an entity that reports to ASIC. You might have already been large and you're reporting, but perhaps you've got other entities that are higher up in the group chart or the group structure, and it's possible that those entities don't do much. However, if they are required to report or their companies under the Corps Act, it's quite likely that those entities that perhaps have never reported or only lodged sort of $2 parent entity accounts, that sort of thing, that they will now need to prepare consolidated and audited financial reports also. So that's just something to be aware of as you look at the impacts of the removal of special purpose. If I jump over to what's happening in the not-for-profit space around special purpose, so covered the for-profit space. In the not-for-profit space, the removal of special purpose is actually a lot harder, or a lot more things to think about. Not-for-profits report at a far lower level of turnover and size sophistication than for-profits do. And so the AASB recognised this, and what they've done is they've set up an advisory panel to look at how can they remove special purpose reporting for not-for-profits, and what should they do about the complexity and how should they deal with particularly the smaller end of not-for-profits. So I'm a member of that panel, and I'm going to take you through what's been going on and where this is at. So as a response to, or early on in that discussion, I think there was an understanding that charities or not-for-profits report at a very low level, and applying the full, in effect, IFRS-based accounting standards, which Australia has, to charities at the very small end is really quite onerous and perhaps not appropriate. And so they've proposed, and it's going to be called Tier 3, they've proposed that a new standard or new suite of standards, I think they'll put it in one standard, it will be developed for smaller end not-for-profits. At the moment, that would, the discussion is that would apply to that new medium category of that ACNC charity. But in reality, that's going to be up to the ACNC and potentially up to ASIC as to what level of not-for-profit this Tier 3 could apply to. But they're being developed with the 500,000 to 3 million turnover type charity in mind. If you're already doing general purpose financial statements and you're right across the current standards, there will be an opportunity for, even if you're below that $3 million threshold, you can apply the other standards, but you need to pick one or the other. So I'm going to give you an update as to where that project's at and what they're looking at. So there's a few key items that have come out, and they're the items, not surprisingly, that caused the most amount of question, I was about to say grief, for the not-for-profit space and confusion. And they are around leases, the revenue model, and then also a little bit around current year adjustments and errors and how you show them, as well as around consolidation. Now, consolidation, I'll talk about that in a minute. It's a little bit separate. But the other items, they're only being discussed in this Tier 3 context. They're not being discussed or proposed wholesale change to the existing standards for larger not-for-profits. So this is only that medium tier. Again, it might actually be a higher threshold than what we're currently looking at. Depends on what the ACNC does. Where are we at? There's a discussion paper, or the first discussion paper is due by the end of this year. That will provide you with AASB's thinking, their initial proposals around what Tier 3 accounting standard would look like. I'm going to take you through some key highlights around what I expect to be in there in a moment. That gives you or the sector a chance to respond and give feedback. As a result of that feedback, then the AASB will issue in 2023, likely the back end of 2023, an exposure draft. And that's their proposed standard. Again, second opportunity for comment and final opportunity for comment. And from there, accounting standard would be developed. Suggest that would likely come out in 2024 with a couple of years before implementation is required. So that's the timeline we're on. For Tier 3 reporting and the removal of special purpose reporting for not-for-profits. So what are they talking about? Again, these slides will be made available. I know there's a lot of information on the next couple, but you might be able to go back and read it if you're really interested in sort of this upfront or early on information. So income recognition has caused a lot of issues for not-for-profits and continues to because of the complexity of AASB 15, which talks a lot about performance obligations and your promises under any contract with a customer. Do they meet a sufficiently specific threshold test? And then there's a whole series of decisions around, well, how and when would you recognise revenue? The proposal for the discussion paper is to make it a far more simplistic model. And really it comes down to, so where you have an agreement that has a common understanding between the donor or grantor or person providing the government, whoever providing the funds, that is evidenced in some sort of writing or some other form, and that evidences that the entity is expected to use that income in a particular way. You recognise that income in a way that the current wording is that most faithfully represents the amount and pattern of consumption by the entity. In my view, this is really wide. So we've gone from the previous standard was a controls-based test. It was really narrow. I guess the ability to defer got widened with AASB 15, perhaps not as far as some organisations would have liked, and it's quite technically written. This one opens the doors a long way, in my view. So really interested to see feedback around that and how much things like donations or fundraisers for a particular overseas aid project or emergency response or something like that, whether you could now get general donations in effect to be deferred and then matched with the spending. I read this as though you probably could, and I'm really interested to see whether the sector thinks and whether the AASB in the end thinks that's too broad, and you're going to end up with every not-for-profits in effect just breaking even a lot with deferred revenue sitting as liabilities. So we'll see where that one ends, but that's the current wording or what I expect to see in the discussion paper. In relation to financial instruments, there's some, so think investment portfolios, that sort of thing. The proposal is that they'll be measured at cost and not through, and the movement in the fair value, not through the profit and loss, but back through reserve. I think there'll be some pushback in relation to this. In effect, a larger organisation has the choice between fair value and reserve accounting, in effect, subject to certain conditions. Whereas this seems to push the small ones down, put it through reserve, and it never, in effect, never hits the profit and loss. I think, personally, I don't think that removing choice is simplification. And so probably my initial view, at least, is I'd push back on that one, but we'll see what the sector says. In relation to leases, and I think this is recognition that the current lease accounting doesn't make sense at a smaller level, and a lot of perhaps less sophisticated readers of financial reports really don't understand why you would book an operating lease on the balance sheet. And so they're looking at bringing back a model that, in effect, lease payments are recognised as an expense on a straight line basis over the lease term. So this is the same language that was in the previous lease standard, in effect. So, so that's what's proposed there. I think that's a good thing and will be well supported. Where you've got assets, obtain assets, so think donations other than cash, so you might get a property or a car or something like that is donated to you. The options will be you can record those at cost or fair value. At the moment, other than minor or immaterial individual items, think your op shop and stuff like that, are required to be recorded at fair value. So that is a step down in complexity, the level of difficulty that sometimes and costs that it takes to measure fair value on if you receive an asset of that nature. So that's probably a good simplification. I suspect that one would be reasonably well supported in the discussion paper. And the final, last couple, employee benefits, they'll take away some of the complexity around long service leave. So you still apply probabilities for those in Victoria, less than 7 years, but you don't have to do the discounted cash flow type discounting and what are the future wages and that sort of stuff. So that calculation will disappear. Again, you'll end up in not a very different answer, but remove the technical complexity. And the final one, not sure how this one will go, but the proposal is you in effect, you'd never go back and make retrospective changes, whether you have an accounting policy, there's a new accounting standard or change to the accounting standard, or you've made a prior year error. The proposal is that you would just adjust your opening retained earnings and disclose appropriately. My personal view is I'm not quite sure about the errors and whether you should actually go back and change your comparative, but for simplification's sake, they're proposing those sort of things just impact current year opening retained earnings. So that's what I know of, and I think the key items that will end up in the discussion paper. I do just want to talk about consolidation. So you heard me talk about the complexity and the issues around consolidation in the for-profits 10 minutes ago. The not-for-profits, I think, is even more complex. So the current standard is for not-for-profits, there's a thing called Appendix E within AASB 10. That sets out how should a not-for-profit interpret AASB 10 and the control concept. At the moment, what it does is it just has a concept that if you have the ability, in effect, to control the board, you're highly likely at that point to be into consolidation or past the control test, because the remainders of the test are, and is that other entity, or does that assist you in your pursuing your charitable purpose? So they've taken away about the ability or the requirement to think about, are you getting financial returns or not? And just made it about furtherance of purpose. And I would suggest that if you've got a constitution that gives you the right to, another entity, the right to appoint the majority of the board, you probably put that in there for a reason, which was about furthering your charitable purpose, at least to an extent. And so it seems to me that that's a very low threshold. We have continued to continue to advocate to the AASB that this needs to be reviewed. I'm pleased to say there is a post-implementation review of AASB 10 planned for the second half of this year. So we've expressed to the AASB that we have a number of clients and aware of a number of entities that don't consolidate, so they prepare special purpose. And the main reason they've stuck with special purpose is because they don't think consolidation makes sense. This is particularly the case where you have two entities and one entity has a different charitable purpose to another, and therefore you don't have any legal ability to actually get financial returns. More importantly, we often see that there's actually two very distinct users of those two sets of financials, and we don't see how that would benefit anyone in sometimes putting these entities together in a consolidation. We don't think that's actually useful information to either of those groups. And so we're advocating on that behalf. When we see there will be a discussion paper and feedback around this post-implementation review. So we're certainly going to be writing to the AASB around some of our clients and why they actually haven't implemented consolidation and why they think it's not the right answer for them. So that I just note that this is not just for that tier 3. So AASB 10 applies to all entities, and Appendix E applies to all not-for-profits. So this is a review of the standard that could, if changed, could be or would affect all not-for-profits, no matter what the size, not just the tier 3 ones. Okay, if you have questions on that, go ahead and bombard Edward in the Q&A. I will move on and talk about, now that I've given some context around what you need to report and where special purpose is going, I'm going to give you some information around what is changing this year. So in your financial reports this year, what would be different? First of all, I just want to pick up on, for general purpose financial statements, we've previously had something called reduced disclosure. This is being replaced with simplified disclosure, or the simplified disclosure standard, which is AASB 1060. So if you're a for-profit, you must prepare general purpose reports this year if you have to lodge with ASIC, and therefore you must at a minimum prepare simplified disclosure. You can do full tier 1 or full IFRS if you like reporting like a listed company. Not sure why you would if you didn't have to, but without assuming you don't, you're into what's called simplified disclosure. So there's mandatory disclosures within this standard. The reduced disclosure requirements, which were the shaded standards in the back, or shaded disclosure requirements in the back of each standard, are now gone as of this year. So AASB 1060 effective from 1 July last year. All the disclosures are in one standard. So there's 244 paragraphs. That sounds like a nightmare. In fact, it's actually not too bad. It's actually all broken down with subheadings around particular topics. And so therefore, if you're interested in a disclosure around PPE, you just look in the index, find PPE, and you go and find the 5 or 6 paragraphs that relate to disclosures around PPE. And so you can quickly skip over what's not applicable to you, just because you don't have those types of transactions or balances, etc. The disclosures are based on IFRS for SMEs, which is an international standard for small to medium enterprises. That was never adopted in Australia. We stuck with the full suite of standards, but the AASB's leveraged off the disclosure requirements from that standard and included them in 1060. So I think it's an attempt to more closely align with the international requirements for organisations of similar types, even though we don't have IFRS for SMEs. So what does it look like, or what does this mean? So this is a bit of a complex slide. I'll try and talk you through from left to right. So if you were previously preparing general purpose, so this is not on the slide, if you're previously preparing general purpose, presumably you were preparing general purpose RDR, you will now just convert to general purpose SDS. I'll tell you what that means. So what are the changes in a moment? If you're preparing special purpose, and think if you're a for-profit and you now need to move to general purpose, if you've followed all the recognition and measurement requirements, you in effect just need to put in additional disclosures. So you just move straight to SDS disclosures. However, if you are preparing special purpose, whether you're for-profit or not-for-profit, and you're moving to general purpose SDS, you will need to restate the prior year and comply with all the accounting standards for recognition and measurement and the SDS standard for disclosure. If you're not-for-profit and therefore you can continue to prepare special purpose and you choose to do so, so AC&C reporting, for example, you don't have to apply this standard. However, we would suggest that if you've had previous RDR disclosures or there's relevant disclosures within an SDS, we would suggest that you start to include those types of disclosures, particularly if you're over the $3 million mark, because it's likely you will need to go there anyway. I'd also note that there's new requirements around key management personnel and related party disclosures, which I'm going to go through in a little while. So they're coming anyway. And so that's the way, or this is in effect, I guess, the decision tree around what you need to do in relation to SDS this year. So what is this new standard, or I'm just going to pick out what's different. So a few things around RDR that are changing. The first one is the statement of changes in equity won't have to be there, and I'll talk about what that means. We've got some minor changes in relation to revenue and leases, and some new disclosures being introduced, which I'll also talk about in a moment, but primarily around your legal form, the requirements for audit fees to be in there, and a lease maturity analysis, etc. There's a really good guide put out by an organisation called Caseware, which most audit firms, including ours, use for their financial reporting template. So if you prepare your own or have your own financial statement template and you need to convert it to SDS and you're wanting a guide, please just email into me or Georgia, and we'll be able to send you out that Caseware guide. It's no cost, it's not mine, but it's actually really well laid out, and I think it's a useful tool if you're looking for something like that. So statements of change in equity. If you only have in your statement of change in equity or in your equity section profits, payments of dividends if you're a for-profit, and then some corrections prior period change in accounting policy. So you really don't have much going on in reserves. You can take the statement of change in equity out. So what does it look like? On the left-hand side, sorry, a little bit small, you'd see a traditional profit and loss. You will now be able to simply have an opening retained earnings line. Sorry, I'm looking at the wrong screen. Opening retained earnings line there, and then in effect coming down to your closing retained earnings. If that's all you have, I think it makes sense you can remove the statement change in equity. Where you have a lot more going on, I think the statement change in equity can be helpful, and it's in most templates anyway. So we'd probably only be removing it if you only had very simple profit for the year adding to retained earnings, and that is in effect your equity section, and nothing else changes. So in relation to revenue, there's an increased push for greater disaggregation and greater levels of disclosure around revenue. That came in with AASB 15, but we're seeing also more emphasis being placed on. So on the left-hand side of this slide, you can see here's an example disclosure, which is, I guess, is a bit more disaggregated and more complete. It doesn't have to be this format. But for for-profits, you've got this distinction between services, goods, and when you recognise revenue at a point from customers at a point in time or over time, and then there's some disclosures around how or what basis you're doing that on. And so you see that disaggregation both at the top and the bottom. For not-for-profits, again, the nature of that revenue is also divided up. You'll see an example here where this one is divided up by region. It doesn't have to be region. It could be a type of service line, could be more appropriate rather than region. So different types of products where you had distinct different divisions, for example, within your organisation, that would also make sense. So that's more the type of recommended disclosure. And I think what AASB 15 was trying to get at, but perhaps we've been slow to disaggregate it out as much as what was intended under that standard. In relation to leases, this is, and again, this is a bit back to the future. And so we've now got under AASB 16, you've got leases recorded as liabilities on the balance sheet. Before that happened, we had what was called the maturity analysis, where across the top here you had 0 to 1, 1 to 5, 5+ years, what is your total undiscounted liability? That will be different to the amount that's actually in your balance sheet because it is undiscounted. So we will see there these two amounts. So option one puts the maturity table and then says here's what's actually recorded in the liabilities. Option two just formats it the other way. So here's my liability and here's my maturity analysis or the timing of that. So again, this harks back to the previous lease standard where this type of disclosure was required. So it's in effect back in again. So they're probably the main examples. I might just quickly flick back. So those other disclosures which I talked about. So you need to say what's your legal form and where are you domiciled. So typically Victoria, Melbourne, company limited by guarantee or proprietary limited company, that sort of thing. What are the first time adoptions when you've adopted a new standard? You need to disclose that. You need to disclose your audit fees. Where you have imputation credits available for future use, you need to disclose that. So that's a for-profit disclosure. So where you've got your ability to, in effect, frank future dividends, and your lease maturity analysis is back. So they're the other types of disclosures that are required. I don't have examples of those in the slides. Moving on from that, I just want to talk about a couple of other disclosure items, and we're running really well on time. So you're lucky, you might get away early, I think. In relation to the ACNC, they've put out a best practice disclosure guide for government funding. I would note that they really didn't consult with the profession or with the AASB a whole lot on what best practice was. So perhaps there was another agenda going on here, but in effect, they've put out a guide. So then this is only for charities around the disclosure of government funding. And they're saying best practice is you would list each level of government and disclose total revenue by each level of government, being federal, state, local. The names of the government departments where you have multiple or where you only have one. For example, you'd put in the name of the government department up to a practical limit of, they've said 10. And where you are on a fee for service type arrangement, think aged care, NDIS, disability, that sort of revenue stream, that you separately disclose where it's for a provision of good or service as opposed to some sort of grant and that sort of nature. And the second, or going on from that, there's also an unearned income disclosure required. So where you've got unearned income for funding received from government, you would split it down, I think, by level of government, not necessarily government department, I don't think, but they're saying that unearned income. So again, best practice, not mandatory. Where as an auditor, I'm not going to tell you you have to put it in, but I think it's worth considering. If you think that provides helpful information to the readers of your financial report, then that's something that would be encouraged. The other item within that best practice disclosure was, again, a return to the past around, we used to have an economic dependency note disclosure requirement going back, this was probably 15 years ago. So where you're a charity, but it could equally apply to a for-profit, where you have a significant level of support from government or from a particular customer, etc., that including a level of economic dependency and including a note around economic dependency is useful information for readers to understand that if that stopped, that could significantly impact the organisation. And so this is something I think that it actually is a good disclosure, and we're probably going to see that in most sets of reports where there is a significant amount of funding from a particular government department or a single source. A couple of just recent updates to accounting standards as well. They apply to the not-for-profits only. So the first one is around peppercorn rent. So when the lease standard came in, there was a lot of conjecture around should you be fair valuing the rental or the right of use asset under an operating lease where it was peppercorn or significantly below market value. The sector pushed back on that, and understandably so. It was complex and really and costly to go and obtain those values. And perhaps there was questions around how much useful information that would actually provide anyone. The AASB listened, put in place a temporary exemption to go back. That exemption's now been made permanent, both for historic peppercorn leases, but also new ones. And so you will not have to fair value a peppercorn rent or lease going forward. So I think that's good news. The second one is there's a number of not-for-profit based examples around revenue recognition in 1058 and 15 that were good examples, but perhaps didn't explain quite enough how they got from the facts in the example to the conclusion of how you recognise revenue and why. So some of those examples have been expanded, things like scholarships and accounting for those sort of examples. They've been expanded, and they and given some more clarity around why. So if you're looking at revenue recognition and you're familiar with some of those examples, or would utilise some of those examples as the basis for what you're doing, just go back and check the updates to those, or just ask us or your auditor around which ones changed, and you can find that narrow scope amendments standard 2 that updates those examples. So there's a couple of little extra things just to be aware of. So what else is changing? So this is not this year. It is for for-profits. If you think for-profits were special purpose, now general purpose, you must now have related party and key management personnel disclosures. So I'm going to talk about them in a moment. I'm going to put it in a not-for-profit context, but it's really the same. So if you're general purpose, you've actually got to comply with this standard already. So you should be across this. However, under the new ACNC requirements, from 2022, a large charity with 2 or more key management personnel will need to report aggregate remuneration in their AIS, so not in the accounts, in the AIS. But from 2023, all charities who lodge financial reports must comply with AASB 124, which is the related party standard, which has these disclosure requirements in it. We think this is quite a significant change and really an uplift in what's required. Related parties and the capturing of those, probably something that we'd say our client base doesn't do particularly well, and the sector doesn't do particularly well. And it's certainly something that's in the news, something that's focused on where a charity hits the media. It's very often because of perceived related parties, transactions, conflicts of interest, etc. And so there's a real uplift in emphasis on this area for particularly ACNC related charities. But like I said, anyone producing GP accounts will need to apply. So just to go back a little bit, so a related party is any director or responsible person. So I think anyone on the board, any key management personnel. So it's really the C-suite, if you like, CEO, COO, CFO, those sort of people. Any organisation that the entity controls, has significant influence over, or any entity that has control or significant influence over you, and any other sort of associate, joint venture, sort of where you've got an element of influence or a reasonable amount of influence, even if you don't have control. So they are broadly who are related parties. I'll just note that it also includes close family members of anyone on that board or in that key management personnel group. And so any organisation with a large board actually has a large number of potential related parties that you need to think about this for. So what are related party transactions? So typically they could be sales or donations, so revenue. They could also be expenditure, be it on goods or services or property, which are related party transactions around leases, leases of property or other types of assets, any transfer of property, plant, equipment or IP, loans, guarantees, anything like that. Employees, particularly employees of board, who are related to board members, that sort of thing, they're all related party transactions. I would just note that it doesn't have to have a financial transaction. So where you've got a not-for-profit board that's doesn't receive any remuneration, that's still a related party transaction. It's just that they're providing their services of board members or a director for zero. So you still have a disclosure requirement around something like that. So it doesn't have to be for a fee or a dollar amount to fall within the definition. Just a transaction, be it a good or service or a provision of something else, can be sufficient. The ACNC's got a guide out on how to manage this change, giving us a change for charities, and they're pointing to, in effect, your requirements under the Governance Standard 5 to really manage conflicts of interest. And if you step back and think about what a related party is and related party transactions, inherently there's a conflict of interest going on either from a board member and either a close family member, the board member directly, or something like that, similar for key management personnel. Or if it's another entity, as a board member, you've got to make decisions in the best interest of the entity. And if there's another related entity involved, then there's a conflict in effect between who are you acting for, which entity, and is that balanced at least. And so Governance Standard 5 deals with that. I'd note that the words they've lifted out of Governance Standard 5 are the words that's in the Corps Act. It's the words that are in the Incorporated Associations Act. Every board, no matter sort of how you're structured, has these basic responsibilities that are pulled out in Governance Standard 5. So there's acknowledgement of that, and therefore there's a requirement that you manage related parties similar or in the same way as you'd manage conflicts of interest. And so I just wanted to unpack that a little bit. So what have the ACNC said about this? So they're saying you really need a policy and a process or procedure for dealing with related party transactions. And that policy should set out a framework of controls to make sure that all related parties are identified, authorised before they occur, and appropriately documented and disclosed, and where applicable, which would be in most cases, managed in accordance with your conflicts of interest as well. And so that might be someone leaving the room, etc., or not voting on a particular matter. So some related party transactions occur all the time and every month. So I think rent, if you've got a related party and there's a property agreement, so you only have to deal with that up front and then at any renewal or change of price. Others might be ad hoc, and they might be for small amounts. And so we perhaps see this not done particularly well. So the ACNC have a template. So if you look up ACNC related parties, you'll land on that page, and there's a template for recording related party transactions within a register that might be appropriate if you don't have much now. It's my view, I guess in our view, that related parties really should be managed and documented in conjunction with the conflicts of interest. Now, if you are a board and maybe at the start of each meeting, you say, are there any conflicts? And those get noted in a register, and that gets put in the back of the board minutes somewhere, or the board pack or board documents, some sort of permanent record. Often I've asked for that, and it's not necessarily up to date. It doesn't have the spouses in it or the close family members, particularly if they're business owners or those types of entities or potential related parties. So it's often out of date, not complete, and it doesn't go beyond the board. Now, if the finance or your delegations of authority have pushed down to finance, CEO, etc., to they are able to enter into various transactions, I think they need transparency over who's on that register, who are the potential related parties. So again, they can make sure that they meet your policy around getting it identified, any related party transaction identified and authorised before it actually occurs. So I think there's some thought to go into this around how do you push this into into a business practice rather than a governance compliance requirement. And so, we're happy to talk to people further about that, or give you some advice around some of that. But I think that's something well worth considering as the increase on focus on related parties continues, and the disclosures are coming for all organisations either this year or next year, really. So that's it on that one. Last bit of the slide, so we are almost there. We'll finish, should be finished around about 1. Just want to talk to a couple of not-for-profit issues that we're seeing some real movement on, and we've got some concerns over, and just want to highlight those. So I'm just going to skip through 3 of them. The first one's around PBIs. So if you're a PBI entity, and you were registered as a PBI before 2012, which is just when the ACNC took over from the ATO. So that's all that is about. So if you have an historic PBI registration, there's reviews, or you will be reviewed. Now, whether or not you know it or not, you will be reviewed by the ACNC/ATO in the not too distant future. These have already started. The ATO is doing PBI reviews of every PBI registered pre-2012. To be a PBI, there's some more guidance has been released since the ACNC was established, and their view is that your main purpose, and it's true, your main purpose must be the provision of benevolent relief. Any other purpose must only be incidental. So it's got to be minor. What are they doing in these reviews? They're looking at your constitution to make sure that your purpose is only benevolent. If you have purposes in your constitution that aren't benevolent, that is a red flag for them. They're looking at your website and seeing what you're saying you're doing and what you're promoting. And they will also post that. They likely will send you a questionnaire. And that questionnaire will ask all sorts of questions around what you actually do and your activities. Our observations is we've seen, had some clients and seen some others where that questionnaire has been answered in good faith by the organisation, but perhaps not with an understanding of the implications of some of the answers, where some of the answers they've provided are perhaps really good things to be doing, but may not be benevolent by definition. And if you're we're doing these things as well in a questionnaire, if the view's formed that they're not incidental, your PBI is at risk. And so would strongly recommend that if you're a PBI, you have an external review of your status and both your constitution, your website. We've seen the questionnaires and what sort of questions are being asked from the ACNC or /ATO. That someone does a review of that. So you can do that internally if you have the skill set, or an external advisor could do that. So we recommend that, but we absolutely recommend that if you get one of these questionnaires, that you seek some advice or review around your proposed answers in those questionnaires, just to make sure you're not overemphasizing something that could then be seen as a problem or taken as not benevolent, and then you're in effect on the back foot, and the ACNC is making a presumption you're not benevolent, and you've got to in effect fight your way back from that answer to demonstrate benevolence. So we just suggest you be really careful around those things. Again, please feel free to reach out to us if you have concerns in that area. The next one is if you're a not-for-profit organisation who's not an ACNC registered charity, so think sporting club, peak bodies, some of those member-based organisations, etc. If you're not under the principle of mutuality, you will have never lodged a tax return, but you've still claimed income tax exemption because you're able to self-assess under a series of potential categories. From 1 July 2023, you will need to lodge an assessment of income tax exemption. Again, we expect that to be a series of questions. Haven't seen a draft on that yet. We would be recommending, again, depending on what those questions are, you may want to either get some advice or get that questionnaire at least reviewed in year one to make sure the way you've answered, there's not some inadvertent or misinterpretation possible, which puts your tax exemption at risk. We also think that there's likely going to be a number fall out, which really should be ACNC registered charities anyway, which puts you into governance standards, external conduct standards, all those other requirements of the ACNC. So we're expecting to see the result of this may be that there will actually be more ACNC registered charities. So if you're one of those type of entities, or you're on a board of one, there's heaps of them out there. There's hundreds of thousands of these entities out there. We just suggest just be careful, seek advice if you need it, and have a think about reviewing those your tax status before this 2023 deadline. Finally, I just want to talk to land tax. In December 2021, the Victorian Land Tax, sorry, I'm not across the other states, but the Victorian Land Tax Act was amended. And basically, you're only exempt. So if you're a charity, you're exempt from land tax, but you're only exempt if the property or land is used and occupied by the charitable institution exclusively for charitable purposes. So there's been an uplift in the language here, and made the ability for exemption narrower than what it was. And so we're seeing issues around this, around where you're a charity and you have vacant land, and you're not, and if you look at that definition, if you're not using and occupying it, your land tax exemption is at risk. And so if you have vacant land that's really been sitting there, the SRO is really taking a view that that's land banking, and therefore you may be subject to land tax. If you have residential or commercial property that's not rented out by either used for your own charitable purpose or rented out to another charitable organisation for their charitable purpose, you have land tax obligation. Likewise, if you rent part of your property out, so where you've got a property and it's got a cafe on it or things like that, you again have potentially a proportional land tax obligation. And so we're seeing this as these are SROs starting to review and picking up issues where they're issuing assessments. So given it's probably Victoria government is, like many states, I suspect is looking for revenue at the moment. They've run some deficits in a difficult time. If this is and this is probably some easy wins for them, I would expect that they'll continue to look at this area around charities and use and occupation of land that they hold. So that's the third issue that we're seeing. So that's it. I'm going to cut it off there. So again, thank you very much for attending. I'm going to try and stop sharing my screen, and maybe we'll jump back in, hopefully. Well, that worked. I can't see if I'm on the screen, but so I'm just going to jump back in now, and Edward might jump on, and he's going to answer some questions or ask them of me. So thanks, Edward.
So I think it's been pretty quiet in terms of questions, and I think that's probably reflective of the fact that a lot of the changes coming up are rather conceptual and big picture. There's probably less of the sort of nuts and bolts stuff we dealt with revenue recognition and some of the leases and some of those complicated standards. So perhaps some things that people might be sort of just thinking through, we could talk through in terms of entities that might be doing special purpose and aren't necessarily sure they're complying with all the accounting standards and may have to move to general purpose, or may do so in the future anyway. Where would you, as a general principle, expect to see the most challenging parts, where there's going to be the most judgments, there's going to be the most amount of work?
Yeah, thanks, Ed. So I think the main ones are, again, you've sort of got these two categories where you're following recognition and measurement. The transition to general purpose is really a disclosure one only. So it's about what disclosures and additional notes, usually not too difficult. And certainly something that we'd be quite familiar with helping clients with. It's about updating the template, typically for things like related parties, lease disclosures, some of the other, cash flow reconciliation, perhaps some of those types of disclosures. Again, a little bit of work, data capture, but not necessarily overly onerous. But where you've got haven't followed recognition and measurement, and the typical ones are around lease accounting, revenue recognition, those sort of things, perhaps impairment, or where you've got intangibles. I've got some organisations that fair value buildings that they use but don't depreciate, some of that sort of treatment. There will be a requirement to change your accounting treatment. Leases, for example, is a bit of a complex calculation, so is long service leave. And so there's a bit of work around getting some of those calculations and accounting treatment done. But I think it's something, particularly if you're not for profit, you've got, and you've been special purpose until now, you've got a number of years to get ready. So I think the first step is in 1 year, go ask those questions of your auditor, or have a think about what are the areas I'm not complying with, and therefore what do I need to do? And then the next year it might be, what does that look like? So well before special purpose is gone for a not-for-profit, you actually understand what the implications are. I think it's about understanding. And once you've got that understanding, it's relatively easy in the majority of cases to work through, well, what then do I have to do, and what accounting treatment do I have to get familiar with? And so it's a heads up to be, if you're well prepared, it's not a significant change. If you leave it till the very end and you've got no idea, it could be quite a significant amount of work in year one, and quite a significant amount of explanation to a board and potentially members and those sort of things. So that's probably the process I would try and work through.
And I guess as an extension to that, there's probably a question around entities who on the border of perhaps they might be eligible for, say, a tier 3 in the future. What's your advice for them? Do they sort of just keep going, doing what they're doing, and see what happens?
Yeah, yeah, really, really hard. Like I said, the new tier 3 is being written with that medium level in mind, but in the end, it's going to be the ACNC that decides whether it only applies there or whether it can apply higher up the chain. And so we just don't know how that will play out. And it could change with change of government or change of commissioner or whatever. So it's not necessarily fixed forever either. I would suggest where you're less than 3 million and you haven't done lease accounting, for example, I would hang out where you are and just continue to do what you're doing. As that discussion paper becomes an exposure draft, becomes a standard, and we understand what level that would apply, I would suspect you're going to never have to adopt that lease standard in its current format, and you're likely to be in the tier 3 category. Then why would you move to something more complex just to go back to something more simple? So it's probably is same with revenue recognition. If you haven't adopted 15, it's probably a matter of hanging out where you are for the moment and monitoring over the next couple of years, what does this mean? If you're an organisation that's turning over 20 million though, I would suggest it's quite unlikely that you're going to be in that tier 3 category. And therefore, I suggest you get on with those steps that I mentioned before around understanding the implications of moving from special purpose to GP.
And would your advice be similar in terms of staying where you are, but I guess understanding what potential issues you could have in the future if legislation was to change in respect to basic religious charities who are largely exempt from the reporting regime at the moment?
Yeah, that's a good question. I think you will get time. And this is just my personal view. I don't have any inside information. At the moment, BRC is not on the chopping block or on the agenda as far as we are aware, and we're in all the discussion groups with professional user groups with the ACNC, etc. So I think if it ever came back on the debate table, we would know as early as anybody, and would let you know as our clients and people who attend this sort of thing. I think if they were to remove BRC, you would get a reasonable lead time. So I probably wouldn't be hitting the panic button. What is an interesting question or a side note to that is we're seeing a number of so we work with a number of church denominations, etc. They are making moves towards advising their local churches and things like that. There's a number of them advise them to incorporate. And so if you're an incorporated entity, you can't be a BRC. So either incorporated association, company limited by guarantee, that type of entity, you cannot be a BRC. And so perhaps in that context, it's worth considering. So if you're considering, is it better from a governance, asset protection point of view to incorporate, you need to then start to think about what are the financial reporting, audit, review type implications of that. So it's probably equally that as anything else, as opposed to the removal of BRC. But it's a different way of looking at the same question, I think.
Okay, maybe one final one I'll throw in, just in terms of the related parties and the key management personnel disclosures. So they'll obviously be new for some organisations. I guess I assume some people will look at it and say, oh, okay, I might have concerns about how much they have to disclose and things like that. What's your sort of advice? Yeah. Obviously, there's judgment involved, that kind of sort of thing.
Yeah, so we often get questions around, hang on, the board members donate, or their kids go to the school, or the daughter's employed as a teacher at the school, or what. So we have all sorts of scenarios which may be a little bit sensitive. The disclosure requirement is about the nature and amount and who the related party is. We've taken the view that where board members, for example, key management personnel, are just donating to an entity they're on the board of, we don't see that the requirement is disclosure of those names and amounts. We just think that we should make, because clearly that is an arm's length transaction. Likewise, where there's a close family member employed, I'll use the school example, there's very clear tables of salary rates. If they're just the same as everyone else, we're not, we're saying let's make, you've got to disclose that it occurs, but that it's based on the typical salary rate or whatever language is applicable to the particular entity. Where there's things that aren't arm's length, it's difficult to determine what arm's length might be. So where there's a rental arrangement on a property, those sort of things, where there's director remuneration, so there's clear remuneration being paid, I don't think you've got any scope around perhaps making the disclosure but not making as specific as in those types of scenarios, because there is a question around, is it arm's length, and therefore requires that more detail around that disclosure.
And I think I would add to that as well, the accounting standards talk about classes of related parties and do allow for groupings into classes and aggregation to some extent. So there is judgment, and materiality is relevant too. So obviously if there's very large transaction with one single related party, then that would be more likely to need to be disclosed, as opposed to a whole bunch of medium-sized ones with many related parties of a similar class.
Yeah.
I think are we just about done for time?
Yep. But we are done for time. Listen, thanks, Edward, really, for some of those questions and answering some. Really appreciate it. Again, to all our clients and contacts, thanks very much for attending. If you have any questions, please don't hesitate to reach out to us. Happy to engage or assist where we can. So otherwise, to all our audit clients, looking forward to seeing you very soon. Hope you have a good afternoon. Again, thanks for attending. Really appreciate it. But we'll sign off here. Thanks a lot.